Now, I accept you may think I'm being boring here, possibly not for the first time, but avoiding fallers is just as valuable to a portfolio as is picking the winners. And before you start looking for me on Twitter to beat me up, I should know what I'm talking about. I've been a fund manager, and then as an analyst at a large investment bank, I talked to fund managers for every working day for 12 years. And take it from me, the best money managers focus on risk and their potential downside every bit as much as they do on return and their potential upside. Think about it. Any stock that halves on you has got to double just so you can get your money back. That's pure maths. So dodging disasters can be just as valuable as spotting the next superstar. The big question is, what are the telltale signs that a stock may be an accident waiting to happen? Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of Breaking the Mould, our regular markets review, we're going to look at one potential shortcut to spotting a stock that could be potential trouble. Now, in the end, you need to thoroughly research any company before you even think about buying its shares. But fabulously successful American investor Charlie Munger, Warren Buffett's vice chairman at Berkshire Hathaway, boils it down to just 4 questions you need to ask. 1. Do you understand the business? 2. Does the business have intrinsic value or durable competitive edge? 3. Does management have integrity? 4. Does the stock come at a reasonable valuation? In other words, if you don't understand the business, aren't sure the company has pricing power, don't trust the management, or fear the shares are expensive, you may need to think again. And even if the stock passes the first 3 tests, valuation will still remain a key hurdle. Now, there are lots of different ways you can value a stock, but you can overlay those with a further screen that's a bit quicker and easier to run. One way, therefore, to spot a potential dog is to look at stocks and sectors which look overhyped and frankly just overbroked. In other words, the companies which have the most analysts covering them in relation to their market capitalisation. After all, I'm sure the analysts are doing their best, but they could be banging the drum in the hope they generate commission, either from share trading or more likely corporate activity, such as new listings, secondary offerings of paper, and merger and acquisition activity. Well, I've looked into this, and I looked into it a year ago, January 2015. I did it in one of my weekly blogs, and I've revisited the data. From back then, the 10 stocks from the FTSE 350, which had the least market cap per analyst recommendation, on 7 January 2015, an average decline of 35% in 2015. Way worse than the FTSE All Shares 2.5% drop. 9 of the 10 stocks fell, and they were Afrin, Premier Oil, Ophir Energy, Debenhams, Cairn Energy, Acacia Mining, Halfords, Cas Minerals, and finally, Serco. Only one of those names rose, and that was the gold miner Centamin. Here's the chart to show the data. The bars represent the annual performance, the line the percentage of buy ratings published by the analysts following each particular stock. Now, the most overbroked stock of all, Afrin, began the year 24 analysts covering it for just 21 million quid's worth of market cap per rating, and only 3 of those 24s were sellers of a company whose shares fell 96% before they were suspended owing to Afrin's financial difficulties. In other words, the most intensely covered stock was, believe it or not, the single worst performer in the FTSE 350 last year, at least excluding investment trusts. Now, that doesn't say much for the quality of research at all, but it says a lot about the dangers posed by a company that has a lot of debt and whose profits are very sensitive to sudden swings in core changes in its product, price changes in its product, oil in this case. Okay, so that's last year's Hall of Shame. What about this year's list of most overbroked stocks? They've got between 24 and 47 million pounds of market cap per rating each, against a FTSE 350 average of 483 million. They're shown on this chart. The bar is market cap per analyst, the line, the percent of buy ratings on the stock compared to holds and sells. And just in case you can't necessarily read the small print, the 10 names are Ophir Energy, Acacia Mining, Cairn Energy, Poundland, Tullow Oil, JD Wetherspoon, Halfords, Morgan Advanced Materials, Centamin, and finally the bank, Aldermore. Now, This is no guarantee at all the stocks will do badly. One, Halfords has already rallied this year after a better than expected trading statement, though another, Wetherspoon, has skidded lower after a disappointing update. But what I do note is that 47% of the analyst ratings on these stocks are buys against just 13% sells. Last year's 10 most overbroke names, well, they had 40% buys and also just 13% sells, and they were absolute disasters on average, as we've already seen. So let's see what happens in 2016. In the end, what this really shows, though, is once you do your research and a company passes its Charlie Munger's first 3 proven tests, it still has to pass the 4th one, valuation. And one quick way of testing out to see whether a stock is overhyped or not may be to look at number of analysts or brokers covering it relative to the market cap. So I hope you found that interesting, and I look forward to seeing you next time. Thank you.